Welcome back to the deep dive. Today, we are looking at a situation that is, frankly, high-stakes poker disguised as a publicly traded company.
It really is.
Usually when you see a stock trading under, say, $2.50, you assume it's a company on its last legs.
Right. Maybe heading for the pink sheets or just quietly fading away.
But today's subject is a total anomaly. It has a market cap of over $3 billion, a massive, almost religious cult following among retail investors.
And this is the key part. We are standing on the precipice of a shareholder vote in just 10 days that could literally decide whether this company survives or faces a massive, massive restructuring.
It's a fascinating contradiction. You have the hype of the future energy transition, the dream of a green planet colliding head-on with the brutal reality of a balance sheet that is just bleeding cash.
And the timing here is absolutely critical. We aren't just looking at a stock, we're looking at a countdown.
Exactly. Let's set the scene properly because the atmosphere matters. It is Monday, January 19th, 2026.
Martin Luther King Jr. Day.
So the U.S. markets are closed. It's quiet. There are no tickers moving, no flashing red or green lights. We have a moment of silence, essentially, to look at this ticker before the chaos starts up again. We are talking about Plug Power, ticker symbol PLUG.
Right. And as of the close of the last session, Plug is sitting at $2.36.
$2.36.
Now, for context, that is down nearly 48% from its 52-week high of $4.58.
Which is already a huge drop.
And if you zoom out to the euphoria of 2021, you remember the SPAC boom and the green energy bubble?
Oh, absolutely.
We are light years away from those peaks. I mean, we are talking about a stock that used to trade at just dizzying multiples.
It's a long, painful way down. But the mission for today isn't to bash the stock or hype the tech. We aren't here to talk about total addressable markets in the year 2050.
Yo.
I don't care about flying cars or hydrogen-powered cruise ships right now. We want to look at Plug Power through the ruthless, unblinking lens of a Warren Buffett-style value investor.
And that means we're looking for economic moats.
We are looking for margins of safety.
And we are looking for respect for shareholder capital.
Which is a very, very different exercise than reading a glossy slide deck about how hydrogen will save the world.
It is. We are looking at the business mechanics, not the dream. Does the machine actually print money? Or does it just burn it?
And we are doing this inside what I'm calling a 72-hour window of absolute chaos.
Okay.
We have three massive catalysts converging right now.
Okay, let's break them down.
First, the January 29 vote where they want to double the share count to 3 billion. We'll get into that.
Huge.
Second, the end of an era with CEO Andy Marsh stepping down for Jose Luis Crespo.
A major leadership change.
And third, the macro threat of Trump 2.0 tariffs and this bizarre, almost surreal new Greenland dispute that's popping up in the news.
It is the perfect storm. You have internal governance issues, a leadership vacuum, and a geopolitical trade war all hitting at the exact same moment. So we need to be incredibly methodical today.
Let's do it. Part 1, chapters 1 to 3, business management and financials. Chapter 1, business understanding.
So the first question a value investor asks, before looking at the stock price, before looking at the chart, is simply, is this a good business?
Right. Does it have a moat?
Does it have a moat? And by moat, we mean a durable competitive advantage that protects profits from competitors. Think of it like a castle. Do they have a moat filled with alligators that keeps the competition away?
Or can anyone just walk across the drawbridge?
Exactly.
Plug Power pitches itself as this end-to-end green hydrogen ecosystem. That sounds fantastic on a brochure. But let's break down the actual machinery. They really have 4 main segments, right?
That's right.
Let's start with the legacy business, the thing that's been keeping the lights on sort of for years, material handling.
This is the forklifts.
The forklifts.
Correct. This is the foundation. It's the gen drive business. They replace those heavy, toxic lead-acid batteries in forklifts with hydrogen fuel cells.
Okay, and if you look at their client list, Amazon, Walmart, Home Depot, you might think, wow, that's a moat.
You'd think so.
Yeah.
Because once Amazon retrofits a warehouse with hydrogen tanks and dispensers, which is called gen fuel, they are locked in.
Right. It is very expensive to rip that out and go back to batteries. That is called high switching costs.
So it's what we call the Hotel California effect. You can check out anytime you like, but you can never leave.
Buffett loves high switching costs. So that has to be a moat, right?
You would think so.
Yeah.
But here's the trap. A moat is only a moat if it protects profit.
Okay.
If I build a castle wall that costs me $1 million a day to maintain, and the kingdom inside only makes $1,000 a day, the wall isn't protecting me. It's bankrupting me.
And that's the forklift business.
That is the history of the forklift business. Think of the razor and blades model. Yeah. Usually you sell the razor cheap, maybe even at a loss, and you make a killing on the blades forever.
Right.
Plug Power did the opposite. They sold the fuel cells, but the blades, the hydrogen fuel itself, cost Plug Power more to buy and deliver than the contract price they charged Amazon.
Wait, hang on. Stop right there. So they were subsidizing Amazon's operations.
Effectively, yes. For years.
Wow.
They were paying for the privilege of keeping Amazon as a customer. Now, by 2026, they've adjusted pricing, and it provides a base load of revenue. But it's a mature market. You can only put so many forklifts in so many warehouses.
It doesn't offer the exponential growth needed to justify a $3 billion valuation.
Not at all.
So the forklift mode is a bit of a mirage because it didn't generate cash. It was a loss leader that just kept leading to losses.
Pretty much.
That leads us to the new story, the pivot. Segment 2, electrolyzers.
This is what the bulls are buying today, the Geneco business. They are making PM proton exchange membrane electrolyzers.
Okay, so what are those in simple terms?
They're machines that use electricity to split water into hydrogen and oxygen. The advantage of PM is that it's dynamic.
Dynamic? How?
If you have a solar farm and a cloud goes over, the power drops.
Yeah.
PM can ramp down instantly. Old school alkaline electrolyzers can't do that effectively.
And the growth here is actually happening. I'm looking at the Q3 2025 numbers. Electrolyzer revenue was up 46% quarter over quarter.
The growth is real.
They are deploying these massive projects in Portugal and the Netherlands. They're building a gigafactory in Rochester. This feels like the future.
It does. But does it have a moat?
That's the question.
Plug wants to be the TSMC of electrolyzers, the dominant manufacturer driving costs down through scale. The problem is, everyone else has the same idea. You have Siemens Energy, ThyssenKrupp Nucera, and huge Chinese manufacturers. They're all flooding the market.
So it's a race to the bottom on price.
Exactly. It's becoming a commodity. There's no unique secret sauce in Plug's tech that Siemens doesn't have a version of. It's a crowded market.
And Plug is just one of many players trying to win on cost.
And when you compete on price against Chinese manufacturing or German engineering, that is a very bloody war to fight.
Okay, let's look at segment 3, stationary power. This is the AI angle, right? Everyone is talking about how data centers for AI need massive power, and they need it 2004/7.
This is the hot narrative for 2025 and 2026. Data centers are desperate for power. But here, we have to use the next best alternative test.
And who's the alternative?
Plug faces a competitor called Bloom Energy. Bloom uses solid oxide fuel cells, or SOFC.
What's the difference? Why should we care about SOFC versus PEM?
It sounds technical, but it's actually about economics. Solid oxide runs extremely hot and is much better for baseload power running all the time, which is what a data center does.
Okay.
PEM is better for on and off backup. But the real difference is the return on capital. Bloom Energy has a positive return on invested capital, about 4.6%.
And Plug Power?
Plug Power's ROIC is negative 57%.
Ouch. So Bloom is actually making money on their capital, and Plug is incinerating it.
Right. Bloom passes the economic viability test. Plug, in this sector, is the weaker horse. If you are a data center operator, Bloom's technology is often the more logical, efficient choice for baseload.
Okay. Finally, segment 4, hydrogen production. They are trying to build their own liquid hydrogen plants in Georgia, Texas, Louisiana.
This is the strategy to stop bleeding money on fuel. Remember the forklift problem?
They were buying expensive hydrogen.
Right. So the logic is, let's make it ourselves. It's sound logic. But it transforms the company from a tech manufacturer into a utility.
And utilities are capital intensive.
Extremely. You have to spend billions up front to build the plants. Plug doesn't have the balance sheet for that. It's a capital trap.
So let's summarize Chapter 1, the verdict on the business.
No moat. They are price takers on inputs like electricity. They have no pricing power on outputs because of stiff competition, and they are operating in a capital-intensive industry with negative margins.
It's a tough business.
A very tough business.
That is a tough start. Let's look at the people running the ship. Chapter 2, management evaluation.
Buffett looks for three things: intelligence, energy, and integrity. But mostly, he asks, do they think like owners? Do they treat the shareholders' money as if it were their own?
For almost 20 years, Plug Power was Andy Marsh. He took over in 2008. We have to talk about the Andy Marsh era.
It's a complicated legacy. On one hand, he is a survivor.
You have to give him that.
He kept this company alive through sheer force of will and financial engineering when hydrogen was a dirty word on Wall Street. He was the master of the secondary offering, selling stock to raise cash.
He sold the dream, effectively. I mean, he raised billions.
He did. But the cost was massive dilution. And he fell victim to what Buffett calls the institutional imperative, chasing revenue growth at the expense of profitability.
The classic mistake of confusing size with value.
Exactly. If we just get bigger, we'll be profitable. But they got bigger and bigger, and the losses just grew with them.
And by 2025, the shareholders had enough.
They did. There were lawsuits about misleading profitability claims, and eventually the pressure became too much.
He did agree to take 50% of his 2025 compensation in stock, right? A final gesture.
He did. A final gesture of skin in the game. But to a value investor, that looks like too little too late after years of value destruction.
So Andy Marsh is out. And we have the new guard, Jose Luis Crespo. He was appointed president in October 2025, and he officially becomes CEO in March 2026. Who is he? Is he an outsider coming in to clean house?
No, and that's the key. He's an insider. He's been there since 2014. He was the chief revenue officer.
So he's the guy who sold the deals, the head of sales.
Correct. He is the architect of the sales funnel. This tells us exactly what the board is thinking.
What's the message there?
They are saying, the technology is fine, we just need to close the deals. So they promoted their top salesman.
The risk, of course, is that Crespo helped build the current cost structure.
Exactly. Can an insider who's been there for a decade be ruthless enough to cut the costs he helped create?
That is the big question. Usually, turnarounds require a hatchet man from the outside. Promoting the head of sales suggests they want to grow their way out of trouble, not cut their way out.
Precisely. And speaking of growing their way out, we have a major governance red flag. The vote on January 29.
This is huge. They are asking shareholders to double the authorized shares from 1.5 billion to 3.0 billion.
That's a staggering amount of shares.
It signals that management anticipates needing massive amounts of equity capital. They are effectively asking for permission to sell half the company again just to keep the lights on.
It screams future dilution.
If they believed they were about to turn a profit, they wouldn't need to double the share count.
Not at all. They are preparing for a long winter.
Okay, so management is asking for a blank check to dilute shareholders. Why do they need it? Let's look at the numbers. Chapter 3, Financial Health.
This is where we do the triage. Let's look at the balance sheet first. As of Q3 2025, they had about $166 million in unrestricted cash.
For a company with a $3 billion market cap and thousands of employees, $166 million in cash sounds dangerously low.
It is.
That's like having $20 in your checking account when rent is due.
It's frighteningly low. But they got a lifeline. In November 2025, they raised about $399 million through convertible notes.
Convertibles, that's debt that can turn into stock, right?
Exactly. It's an expensive way to borrow, but it was crucial. It allowed them to pay off some high-interest debt and, importantly, unencumbered their assets.
So it pushed immediate bankruptcy off the table.
For now, yes. But the balance sheet is still very fragile.
Now let's look at the income statement. This is the part that always scares me. The scary number.
The gross margin. This is the most critical metric for any business. In Q3 2024, their gross margin was negative 69%.
Okay.
In Q3 2025, it improved to negative 31%.
Okay. An improvement, but still. Negative 31%. Let's strictly define what that means for the listener, because usually when a company grows sales, they make more money.
Not here. Negative gross margin is the cardinal sin of manufacturing. It means that for every single dollar Amazon or Walmart hands Plug Power for a product, it costs Plug Power $1.31 just to build it and put it on the truck.
And that's before the CEO gets paid, before the lights are turned on at headquarters.
Before the receptionist answers a single phone call. This is just raw materials and labor.
So, the old joke, we lose money on every sale, but we make it up on volume,
is literally their business model right now. And when you scale a model like that, you aren't growing a business. You are just accelerating your own funeral.
You are bleeding cash faster the more you sell.
Precisely.
So how long can they keep this up? Let's talk cash flow and runway.
They are burning about $90 million a quarter operationally.
Okay.
With the new cash from November, they have a total liquidity pool of around $550 million.
All right.
If you do the math, 550 divided by 90, you get about 6 quarters.
So they have money until mid-2027.
Roughly. And that explains the urgency of the vote next week.
Right. They need the authorization to issue shares now, so they have it ready before the cash runs out.
They want to fill the war chest before the market panics.
If we try to do a valuation, a discounted cash flow analysis, what is this company actually worth?
It is incredibly hard to calculate intrinsic value when the cash flows are negative. But even if we assume optimistic growth, say 20% a year, and assume they become cash flow positive in 2028,
Which are both big assumptions.
very big assumptions. The model suggests a fair value of somewhere between 75 cents and $1.50.
And the stock is trading at $2.36.
Right? It's trading at about 3.7 times sales. For a hardware business with negative margins, that is expensive.
Very expensive.
A deep value investor would want to pay maybe 0.5 times sales. There is no margin of safety here. You are paying a premium for a money-losing business.
Okay, that is a brutal look at the fundamentals. But the stock market isn't always about fundamentals. Sometimes it's about psychology. Part 2, chapters 4 to 7, market sentiment, ownership, risk, and final conclusion. Chapter 4, market sentiment.
Now we enter the mind of the market. Benjamin Graham said, in the short run, the market is a voting machine.
And right now, the voters are going crazy. We have to talk about the short squeeze.
We do.
I see the data here. Short interest is between 26.5% and 30% of the float. That is massive.
It's enormous. 1 out of every 3 tradable shares has been sold short. People are betting the farm that the stock goes down.
But that creates a coiled spring.
It does. Because if anything good happens.
Anything at all.
Exactly. If the vote passes on January 29, or if they get a government grant, those short sellers have to cover. They have to buy the stock back to close their position,
And that buying drives the price up.
forcing more shorts to cover. It's a violent feedback loop.
And we saw the stock pop 4 or 5% in the last 72 hours. Is that it?
That looks like nervousness. Short sellers might be covering before the vote, just in case.
Yeah.
They don't want to get caught on the wrong side of a relief rally.
What are the analysts saying? The people in the suits?
They're totally split. It's like they are looking at 2 different companies. You have the bulls, like Clear Street, who have a $7 target.
This in dollars?
They were looking at the $8 billion sales funnel and saying, eventually, this pays off. The demand is there.
And the bears?
Morgan Stanley and TD Cowen are down at $1.50 or $2. TD Cowen actually called 2026 the year of reckoning for the hydrogen sector.
Year of reckoning. That sounds ominous.
It implies that the time for stories is over. Show me the money. Investors are tired of promises. They want to see cash on the barrelhead.
And that brings us back to the binary event. The vote on January 29.
It's a coin flip. Scenario A, the vote passes. You get a relief rally because they won't go bankrupt tomorrow. But then the slow bleed of dilution sets in.
Okay. And scenario B.
Scenario B, the vote fails. That is the nightmare scenario. If they can't raise equity, the market will panic about insolvency. The stock could crash.
It's a dangerous game to play. Let's look at who is actually holding the cards. Chapter 5, ownership structure.
This is one of the most telling chapters. We need to talk about the smart money. Remember SK Group?
The South Korean conglomerate, they put in $1.5 billion in 2021. I remember that headline. It was huge.
Right. They bought nearly 10% of the company. They were the strategic partner.
They know the tech better than anyone. They were supposed to bring Plug to Asia.
They were. Fast forward to January 2026. Their ownership has dropped below 5%.
Did they sell?
They didn't sell everything, but they allowed themselves to be diluted. They refused to put more money in to defend their percentage stake.
That is a silent vote of no confidence.
Precisely. If your partner, who is supposed to build the Asian market with you, stops writing checks, that is a huge red flag. It says, we like you, but we don't love you enough to spend any more money.
What about the big institutions? Vanguard, BlackRock, they own a lot.
They do, about 7% each. But don't be fooled. They are passive index funds. They own Plug because it's in the Russell 2000.
They're sourced buyers.
Forced buyers. They don't have a choice. If Plug is in the index, they have to buy it. It's not a conviction play, it's a spreadsheet play.
And the insiders, the people running the company.
We saw Benjamin Haycraft, an insider, sell shares in January 2026. But more importantly, we haven't seen any significant buying.
Which is the real signal.
The stock is at $2.36. If Jose Luis Crespo thinks he can turn this around, why isn't he buying shares with his own money?
If the chef won't eat his own cooking, you shouldn't either.
Exactly. When insiders buy, it can mean many things. But when they don't buy at multi-year lows, it usually means they think it can go lower.
Now, let's zoom out to the world stage. Because Plug Power doesn't operate in a vacuum.
Not at all.
We have to talk about the risks. And usually when we talk about risks for a hardware company, we talk about supply chains or interest rates. But we have a new one on the bingo card for 2026. Chapter 6, Risk Assessment.
We have to talk about the macro environment, specifically the circle of competence regarding geopolitics.
We have Trump 2.0 in the White House, and we have the universal tariff.
Right. The administration has implemented a baseline tariff on imports 10 to 20%. Plug power sources components globally. They get membrane electrode assemblies and rare earth materials from China and Europe.
So their input costs just went up?
Correct. Cost of goods sold goes up. Remember that negative 31% margin?
It's hard to forget.
Tariffs make it even harder to get that to positive.
Yeah.
Every tariff percentage point is a direct hit to their bottom line.
But there is something even more specific and frankly a bit bizarre happening right now in January 2026.
The Greenland dispute.
Yes. I honestly thought this was a typo in the research notes. Are we actually talking about the United States trying to buy Greenland again?
We are. And as absurd as it sounds, it feels like a headline from a satire site. The economic fallout is very real.
How so?
You have the Trump 2.0 administration threatening tariffs on Denmark and Germany, specifically because of this diplomatic spat.
And Plug Power, sitting in Rochester, New York, is somehow caught in the crossfire of a real estate deal for an ice sheet.
It's a geopolitical butterfly effect. Plug needs to sell electrolyzers to Europe. That is their growth engine. Projects like Hyvia in France, H2 Hollandia in the Netherlands, Galp in Portugal.
That's the future of the company.
It is. If the EU slaps a retaliatory tariff on American machinery because of Greenland, Plug's products suddenly get 25% more expensive in Paris and Berlin.
So they get hit coming and going.
It's a pincer movement.
Yeah.
Input costs go up because of U.S. tariffs on Chinese parts. Output prices go up because of EU tariffs on American goods.
This destroys their competitiveness against European rivals like Siemens,
who don't have to pay those tariffs to sell in Europe.
That is a brutal geopolitical squeeze. It's almost impossible to model.
Exactly. It's a risk that doesn't show up on a spreadsheet until it's too late.
We have covered a lot. The broken business model, the management shuffle, the scary financials, the short squeeze, and the trade war over Greenland. It's time for the verdict. Chapter 7. Conclusion.
We have to answer the question, would a Warren Buffett value investor buy Plug Power today?
Let's classify it. Is it a compounder?
No. No moat, burning cash, negative margins. Definitely not a compounder. It consumes capital, it doesn't compound it.
Okay. Is it a cigar butt? A deep value asset play?
Usually a cigar butt is trading for less than the cash in the bank, or it's trading below its liquidation value.
Right.
Plug has a market cap of over $3 billion. It is still priced as a growth stock. It is not cheap enough to be a value play.
So where does it go?
It goes into the too hard pile.
The too hard pile. I love that Buffett category.
It just means there are too many variables to predict the outcome. You have a new CEO, a critical shareholder vote, a trade war, and a business model that hasn't proven it can make a profit.
It's impossible to model with any confidence.
Right. Why swing at a pitch like that when there are easier games to play?
But playing devil's advocate, there is a speculative counter-thesis.
Of course. And this is important. If you are not an investor, but a trader, a gambler, this is an interesting setup.
How so?
If the vote passes, if the Fed cuts rates, if the trade war cools down, that 30% short interest could trigger a massive squeeze. The stock could double to $5 in a week.
But that's betting, not investing.
Exactly. You are betting on the greater fool theory. You are hoping someone else will buy it from you at a higher price, not that the company will generate cash flow. It's Vegas, not Omaha.
So the final recommendation from the value investor's desk?
Hold or avoid. The prudent move is patience. Wait for the January 29 vote.
See what happens.
Wait to see one single quarter of positive gross margins. Just one. And wait to see Jose Luis Crespo buy stock with his own money.
Until then, the risk of permanent capital loss is just too high.
The margin of safety is non-existent.
Well, there you have it. Plug Power is a company with a seductive story, the hydrogen future, but a currently broken business model.
They were effectively selling dollars for 69 cents and hoping to make it up on volume.
And facing a trade war while they try to fix it.
A brutal combination.
As we watch the vote on January 29, ask yourself, are you investing in a business or are you just funding a science experiment that helps Amazon ship boxes cheaper?
That is the multi-billion-dollar question.
This analysis was generated by AI for educational purposes and should not be considered financial advice. Please do your own research before making investment decisions. Thanks for listening to The Deep Dive.